Specifically, I realized that the traditional biotech VCs, for whom I have tons of admiration, were very founder unfriendly, to be very blunt about it. At the end of the day, they work very differently than tech VCs. Tech VCs, when it's Benchmark and Sequoia competing against, Andreessen and Kleiner or what have you, they really are very competitive. They want to give a term sheet and take the entire round in the early stages. They don't really call each other and say, hey, do you want to join me in this round? That happens sometimes, but it's not really the way most tech deals are done. More often than not, you find that they are trying to close a founder or CEO before she can go shop it to others. Biotech is the reverse. Because so much capital is required to even get to a preliminary point of de-risking, you pretty much always syndicate, and you syndicate with the same people. So there's no sense of competition. Valuations tend to be a little bit more suppressed as a result of that. And it also lends itself to a lot of bad behavior.
Hundreds of thousands of researchers around the world are working to improve life and address imminent threats to humanity. Often their research ends up in the scientific valley of death in the form of publications and patents that never see the light of day. That is about to change. Welcome to the Lab to Startup podcast, hosted by Naresh Sunkara, founder and executive director of the Berkeley Postdoc Entrepreneurship Program at the University of California, Berkeley. This show has two main goals: share the stories of those who have successfully founded startups based on their own research, and highlight resources needed to help those aspiring to launch startups in the deep tech space. Whether it's electric cars, vaccines, addressing climate change concerns, or possibly establishing life on other planets, Naresh and his esteemed guests want to help scientists, engineers, faculty, and researchers bring their innovations to market. Learn more and subscribe today at labtostartup.com. And now, here's Naresh.
My guest today is Shahram Seyedin-Noor, the founder and managing partner at Civilization Ventures. Shahram is a very unique guest because of how successfully he navigated transitioning between different sectors. After getting his JD from Harvard and working at firms like Wilson Solsinis and Cooley, he went into investment banking at firms like Goldman Sachs and Bank of America. He then entered the startup world, co-founding and exiting several startups. He eventually ended up angel investing for almost a decade. And based on the lessons learned in these sectors, he launched Civilization Ventures in 2017, focused on supporting cutting-edge innovations in health tech and biology. Shahram has over a dozen exits under his belt, which is a phenomenal achievement. I thought it would be great to talk about how he successfully navigated various industry sectors, which might be helpful to my audience trying to build startups. We talked about various topics like mindsets and accountability, developing EQ, chemistry needed for scientific and non-scientific co-founders and team members, of course, and we talk about his investment thesis. I absolutely had a blast talking to Shahram and hope you will benefit from listening to his experiences as well. All right, Shahram, thank you for taking the time to talk to me. One of your recent tweets caught my eye that prompted me to ask our mutual friend Darren Cook for introduction. And thank you for willing to talk to me immediately. That's very kind of you.
My pleasure. Thank you for having me.
So because that tweet was a starting point, I thought a good place to start our conversation would be to talk about the tweet. It says, the most critical skill for a founder, CEO, or any other professional is not what she or he knows right now, but how they approach learning what they do not know while taking responsibility for outcomes. What have the best founders done differently around this subject in terms of not knowing everything right now, but then being prepared for that?
That's a really good question. In my opinion, the reason I sent that tweet, every time I post something on X, it's usually because it's either fresh in my mind or I've experienced something that I wanted to just quickly convey the lessons from. And in that case, what I'm trying to convey is the idea that you shouldn't be overly impressed with yourself, you meaning the royal you. We should not be overly impressed with our accolades, with our static profile of all the degrees we have, the things we've achieved, et cetera, all these facades of achievement, because they are static. What really matters is what happens from today forward. And that's dynamic. And that's based on fundamentals that you already have in your possession or as part of your character, but how you apply them. And that really is a determinant of success. Because if success were determined by what degree you have, how much time you spent in school, how much money you have, then you would just already be given a trophy for it. There would be no sense for you to start a company and try to achieve something beyond that. So what I found to be the greatest corollaries with success for myself and for others that I've worked with is attitude, an attitude of accountability. It's funny because I think it was John F. Kennedy who said that success has 1,000 fathers and failure is an orphan. No one wants to take responsibility for something that went bad or an outcome which was not the outcome that was desired. And on the opposite side, everyone takes responsibility for success. So whether you're the 1,300th employee at Meta or OpenAI, that's your company and you're responsible for all its success. You hear that a lot. And oftentimes it's used to justify how much money people make because they come out of a story where they may have been the 200th employee at Google and made crazy amounts of money. And of course, they have to justify that, well, I deserved it. But for me, they wouldn't have become Google. And we know that's not really true. To a certain extent, luck plays a big role in life. There's a lot of inertia in these big companies. There's a lot of luck and inertia and everything. And sometimes we're just accidental beneficiaries of that success. But that's not what will drive success in a startup because there the chance of you riding someone else's coattails are almost nil because you're the founder and you're the executive running it. So you don't have the luxury of saying, oh yeah, I was really great as the 12th employee of Pinterest, but for my involvement, that episode, I deserve the fact that I own a $50 million house. That psychology doesn't really work with founders. There is a lot of luck involved in the secular market environment, in a lot of random little things that could happen in a startup, but a little bit less so. And so it's essential that someone have a mindset of responsibility, of accountability. It's essential that they not choose to blame other people for things that go wrong, but rather take account of it themselves. In fact, I was thinking that it's interesting that a lot of people want to blame everyone else for what goes wrong and take the credit for what goes right. But very few people have the opposite mentality, which is to essentially blame themselves for everything that goes wrong and give others credit for things that go right or credit luck. And none of those positions is an absolutely correct one from a higher level perspective. There's an element of luck and an element of personal responsibility and an element of circumstance in everything. But I think that as a formula for success, it's a lot more likely that you'll be successful if your mentality is one of taking personal accountability, especially for your failures or for the company's failures that you're a part of. Let me give you an example. So I started several companies where I was 50% or less of the cap table because I had co-founders. Mistakes were made, to use the third person in those companies. And some good things happen in some of those companies as well. But it's easy for me to say, well, this company had a suboptimal acquisition because of my co-founder. They were the technologists. I was the business person. And I could even justify that through a million arguments and factual this, that on this day, this person did that and I was against them and that was a mistake. I could easily say that. It's just not helpful because if you think about it from a more fundamental perspective, it was my decision to choose a co-founder. It was my decision to agree to that cap table. Those were all my decisions. And so even if something downstream of that may or may not turn out as I had expected, fundamentally, those are my decisions. And so when you really start analyzing things, you realize that your reaction to something or the decisions you made a couple of steps back are very important. And indeed, you could look at it with a clear eye and realize that you could have done something differently. That's not to say that you can avoid all mistakes or that you should constantly blame yourself. This is a mindset that I implement as a constructive measure, not as a self-destructive measure. So I find that it's very useful to say, for example, as a fund manager, I am going to have the best performing fund in my category. Now, what does that mean? Not like I'm that competitive. I don't want other people to do badly, but I want us to be the best. So that means I take personal accountability for our portfolio construction. I take personal accountability if we make a bad investment or if a founder makes a mistake and we're not there to help them. It'll be very easy for me to say it was the founder's fault. Of course, I'm not running that company. But that's a bit of a cop-out. I think the most effective managers will work and do their utmost to help even a company they're not on the board of or they have a small stake in to succeed. And doing that over and over again, that mindset that you're responsible as much as you can hold yourself responsible will, I think, result in greater success. It also makes you easier to work with as a professional. It's hard working with someone that's always blaming other people or that sees everyone else as the problem. It's actually fun working with someone that is humble and says, you know what, you're right. I'm going to do that a little bit differently. I'm going to take more responsibility. I honestly believe that's a superpower for people to have if they're able to fundamentally look themselves in the mirror and hold themselves 100% responsible for as many things as they possibly can, because it's empowering. It gives you agency. It also makes you work on yourself. If you just blame everyone else around you, if all you have are grievances, what's the point of working on yourself? At the end of the day, it's everyone else's fault. But if you have a mindset that you're responsible, that this is your fund, you're going to raise, let's say your goal is to raise 10 million or 100 million. That's my responsibility. Let me give you another example. Every once in a while, I'll volunteer. Someone asks, "You want to help this entrepreneur?" And I try to say yes as much as I can. Nowadays, it's a little bit harder with my responsibilities. But 7 years ago, I volunteered to help an entrepreneur. I had no financial stake in his business. It was a third-party nonprofit that was helping them, and I wanted to help. And he was actually a really, really nice guy and very, very smart, very accomplished. The guy had a lot of presence. He was clearly sharp, just had everything going for him. He even had almost $1 million in sales in his company. And I was his informal mentor. And I would meet up whenever he asked. And I remember this was actually before the market downturn. This was 2017, 2018. And again, I have no financial stake in this company. I was not an investor. I wasn't even in our sector of healthcare. It was outside of healthcare, but I was just giving advice. I have in my own history run companies that do SaaS software and things outside of healthcare. So I had some relevant experience to draw from. And I remember thinking it'll be easy for this person to raise money. I mean, they're doing $500,000 to $1 million in revenues a year, early stage, but that's still quite a bit of traction. And he has everything going for him. And he would come back and it was just clear that he was having a really difficult time raising money. And I remember every couple of months we'd meet, and eventually it came to the point where he was going to shut the company down. And I was really surprised because this company, again, he had everything going for him, great presence, great charisma, speaks the language fluently. He has the right degrees, great family life. There's no instability there. There was a market. People were paying for the product. And I thought it was beholden upon me because I really liked this person and I wanted to be helpful to give a little bit of tough love and say, in my humble opinion, this was your fault. At the end of the day, we're in the middle of a market where every Tom, Dick, and Harry, Jennifer, Susie, and Betty, they're all raising as much money as they want for the dumbest ideas. Stepping back for a moment, we still are in that era. Even in the middle of a downturn, Silicon Valley today and the global economy today is the most entrepreneur-friendly environment in the history of humanity. You can maybe cherry pick and say, well, it was a little bit frothier 3 years ago. Yeah. But zooming out from the lens of 10,000 years or even 300 years, going back to the East India Company where they had a monopoly on spice and teas and they were running governments. How easy would it have been to be an entrepreneur back then? You pretty much had to be a vassal of the state, find some king to sponsor you. We live in a world where almost anyone out here can raise money for almost any stupid idea, much less the good ones. So if you have a good idea and you're doing $1 million in revenues and you're living in the middle of Silicon Valley and you can't raise more money, guess what? It's your fault. But going back to the story, I'll never forget it. The person looked at me and said, because not everyone responds well to tough love, myself included. No one likes criticism. And when I made this comment, I said, and I really tried to characterize it as a compliment because it was, I said, you're so accomplished. I look at you and I see someone that has such presence. For me, the idea that you didn't raise the money you were looking to raise with the business that you believed in really comes down to your lack of maybe not putting in that extra effort that would have resulted in it. He was not ready for that comment. That's not what usually mentors tell you. Usually a lot of mentors are very superficial there to tell you, oh, not your fault. But I told him what I actually believe to be true. And he said, well, it's easy for you to say you're running this big fund. Today, I run a $120 million fund. Back then, my fund was $1 million to $8 million. I was just getting it started. By the way, no rich relatives to invest in the fund, zero contacts in the LP world that gave me a head start in having a fund. I started really from scratch, having been an entrepreneur, having known a lot of VCs, but really not even understanding what a family office or an LP is in a fund. I didn't even understand some of the basics of fund management because I was, even in my prior incarnation as an attorney, roughly 23 years ago when I worked at Wilson Solsinis and Cooley, working with tech and biotech startups, I worked with startups and private and public companies, not with fund managers. I wasn't representing funds and I wasn't incorporating funds, even if I represented funds. So I didn't know what happened in the back door. I was very surprised to learn what I've learned over the last 7 years about how VCs even function. So then I stopped them and I said, where did you get that assumption that somehow I just started with all this stuff? I said, I started a year ago with no capital, no income, absolute zero in terms of where I was starting from in the industry. I didn't have a rich uncle that seeded it. I didn't have a dad who was a VC. Neither of my parents went to college. I had zero insight into the industry from those mechanisms. Obviously, I pay attention. I've been working for now 25 years. Back then, it was 18 years in Silicon Valley. So I knew what was going on, but I didn't know much about fund management. And to have gone to where I was then and where I am today was just, it's been pure hustle with a huge measure of luck, with a huge measure of good fortune. Don't get me wrong. And a lot of people helping me, but I still take personal responsibility for creating this path and creating those opportunities. And I think he was shocked that his assumption on who I was and where I come from just didn't match up at all to reality. And I think that's true, by the way, as a lesson for all of us to think about. We think we understand where other people come from. Maybe you see some celebrity and you're like, well, of course, this person is good looking, rich, famous. You have no idea where that person came from, what their background was, what they're still struggling with today. So don't use that as an excuse for where you are. Take responsibility. That was the very long-winded answer.
This is such a great setup for a conversation. I think there's so many threads we can go after. Speaking of dynamic mindsets and transitioning mindsets, as someone who's played multiple roles as an operator, founder, and investor in deep tech space, what are the biggest mindset shifts that you had to make when transitioning between these roles? And how did you evolve such thinking? I'm asking it from an entrepreneur point of view. As scientists who are listening to this, I think that dynamic mindset is needed. How would one think about this subject? And how did you evolve? Maybe you can talk about your example.
It's a really fundamental point. Maybe I'll anchor this in two different stories and answers. The first one dealing with how I went from my training and my academic background to what I'm doing today. And the second one, what have I learned the most in the last decade and what's been the biggest shift in my psychology? Very clear answers to both of those. So first of all, I was an undergraduate at Pomona College, a college that I'm a huge fan of in Southern California. And I was an econ major. And I was a pre-med for about a year, took biology and chemistry courses, loved biology. Not so much of a fan of doing work in the lab. And I certainly was looking into the future and realizing I had no desire to be a doctor. So I thought, why am I pre-med? Well, because I'm an immigrant. I'm originally from Iran. I was born in Iran. My family escaped Iran when I was 8 after the revolution. So I had this psychology of I got to keep all my options open for as long as I can. And by the way, it wasn't until my first year of college that I even got the permission to stay in the United States. We were in the court systems for about a dozen years since arriving and ordered to be deported multiple times. So when I look at the immigration debate, I can really relate to it quite intimately as an immigrant myself, who was a refugee with my family from Iran, and just having a super tough time getting asylum, which we didn't get because we're not a part of a persecuted religious minority in Iran. We weren't a part of some communist Marxist movement that would have gotten an exemption under US law, ironically, to fast track our ability to stay here. We just had to go through a very long, tortured path. I won't even get into that whole story, but I ended up in Pomona College and finally was able to focus on doing what I really wanted to do, what I really loved. And so that was biology, but with a business mindset and economics being my major. And I went straight from that to law school in Harvard, where I studied law for 3 years, again, with a focus on things that I enjoyed, like startup law, finance, human rights. The most transformational course was my last year in law school. It was a course called The High-Tech Entrepreneur, taught by Jonathan Zittrain and Lawrence Lessig. And by the middle of law school, I knew that I didn't want to be a lawyer. I just knew that it wasn't a good fit for my interest and personality. But at that point, I had about $100,000 worth of educational loans. And Biden wasn't around then to forgive them. So I graduated with loans that I believe, if I recall correctly, were at a 9% interest rate. And it was roughly $100K. So you can do the math. Those pretty hefty payments. So I had to really work for the first few years to pay that off. But I remember as soon as I started working, I began to understand how people really put you in a box. So this is the answer to your first question. The big shift for me was not caring what other people thought I should be doing. Because when you graduate with a law degree from any school, people are like, oh, he's a lawyer. That's what you are. That's your lane. And it's just what I'm doing right now. I have a law degree, and I got a law degree for reasons having to do with more than just being a lawyer. I'm a refugee. I was very curious about international law, about what made America as a society, as a constitutional system succeed. And so I thought getting a law degree would be a way to understand that better, just as a person. That was one of the driving forces. And then as soon as I was there, I realized that I didn't want to be a lawyer. It wasn't a good fit for my particular interests. And so, I was thinking immediately of my escape. Even though law is a phenomenal profession, going to my 25th Harvard Law School reunion this week, actually, and my classmates are running the world. One of them is prosecuting Donald Trump, Alvin Bragg, and others are doing great things, and they're very successful financially in every respect. So there's no knock on that. It's just that it wasn't something that I thought I would be really enjoying long term. So I immediately started looking at other professions, consulting, banking, entrepreneurship. And this is literally from my last year of law school. I had to bide my time a little bit because I had to pay off my loans. As soon as I graduated and started working, the dot-com bubble, the internet bubble, burst. And that bursting of the bubble was something unlike anything else that's been seen since. Even the financial crisis didn't quite elevate to the level of the nuclear winter in Silicon Valley that ensued in the years 2000 to 2002 after that bubble burst. It hit the financial sector. It hit the startup sector especially hard. And so I was definitely keeping my head down, just focusing on making enough money to survive and paying off my debt. And so that slowed me down a little bit in terms of jumping off and doing something crazy. But again, at every turn, I would hear, well, what are you going to do in a startup? Be a lawyer for a startup? I thought that was silly because my goal was to be a founder. So the first thing I did was just not care and resist this constant feedback of this is what you're supposed to be doing. This is what you're supposed to know. But if you look at the most successful people in history, they never paid attention to what, and by the way, I'm not comparing myself to them. I'm just saying that the psychology of very successful people is that they don't care about what other people say about them or what they should be or could be doing. They don't hold those limits to be internalized. They just do whatever they want to do and they get as far as they can. And so for me, I thought, okay, I wanted to first learn about finance. So I started studying finance. I was an econ major, but I started reading more books on finance and investment banking and got an interview at Goldman Sachs shortly after law school. And of course, that is at the time the number one investment bank in the world. Very, very difficult to get a job there. It was the only interview I even got in investment banking. The other banks didn't want to talk to me. And I got an offer within 3 days of starting the interview process. So if you put your mind to it, you can do it. So people stopped asking, why do you want to do something outside of law? But then when I was doing that for a while, the question was, well, you don't know anything about life sciences entrepreneurship, but what do you plan on doing there? And there, once again, I just put my head down and I said, I do want to be an entrepreneur in the healthcare space. It's what I'm most passionate about. I've been passionate about the life sciences since I was in high school. We actually had an amazing public school in Portland, Oregon, Sunset High School, where I grew up. And we had in our AP biology class, Drosophila flies, and we're doing Mendelian genetics on them. So it was really a hands-on experience for a high school student. I felt very privileged, even in a public high school of that caliber, to have the opportunity. And from then, I fell in love with the idea of genetics and the future of that industry. But it wasn't until I joined my first startup out of Stanford as head of business, head of legal, head of finance, that I really got my domain expertise. So I really went deep and began to understand what it takes to run a company. It was a 3-person company that I joined, helped it grow with the CEO and the CTO and others, helped it become a 50, 60 person company. And eventually it was acquired by Illumina. So that was my first foray. And that's where I got real depth in the domain expertise. And the rest is history. Because from that point on, you can draw a pretty linear path as to how I ended up working in healthcare and the life sciences. But those initial few leaps going from law to investment banking and then going to startups, there's a lot of judgmental opinions from those around me, family and non, as to why am I burning my law degree? Why am I not doing what I'm supposed to be? Why am I going outside the lane? And I think you just have to know yourself. You have to just do what you're passionate about. That's the first answer. And the second answer is about maybe the biggest growth experience I've had in the last 10 years. And without going into the details of the individual stories, because they may implicate people, I'll simply state that what I learned over the last 10 years is that EQ is as important, if not more important, than IQ. If one of the chief lessons coming out of school was don't let what people say hold you back, and who you know is as important as what you know. Those are maybe the 2 lessons that I got out of school very quickly. Getting straight A's, doing the best on standardized exams. These are all things that I was accustomed to. A hamster running on a wheel. These are the ways that I used to measure myself when I was in school. These are pretty much irrelevant when you get into the work world. And it requires a real shift in your understanding of what it takes to succeed. Because in the work world, really, there's a huge emphasis on relationships. Sitting in a room and taking exams is not going to get you anywhere, or just being really great at these discrete tasks is not going to make you successful in business. You have to really have a network and understand people well. The extension of that, and the thing that I hadn't yet mastered, not sure if I have mastered it yet either, but that I've been a lot more focused on, is this idea of EQ. And what do I mean by that? So again, being a guy who comes from a background where law school was a difficult experience. Law school was not like business school or a PhD program. These are all very, very rigorous in their own right. But I think PhD programs, you can, in many instances, take your time and hang around. In an MBA program, you're going on these trips and you're having fun. Law school, when I was there, was basically one exam in each course determines your entire grade, and it's a 3-hour exam at the end of the semester. That's it. So it doesn't matter how hard you worked all semester. If you didn't do that exam well, you're done. Yeah. So that's a brutal way to go through 3 years of schooling. And as a result, I thought that was a very bad pedagogy. I'm a big critic of that system that they employed. I did well, but I essentially was focused on doing well on the exams because I realized that that's what mattered for that system. That is not a good way to succeed in business. It takes a lot more than that. But that idea, that this training that I had to always focus on numbers and being the best at this or that is very different than focusing on people and relationships, and also communicating in a way that's different. So one axiom that I think is very important that one should always use in one's life, and this might go a little bit against what some of the things that Ray Dalio says with his radical transparency theory, is that you should praise publicly and criticize privately. If you think you have an issue with someone or they're not doing something well, you can be radically transparent and humiliate them in front of a group. I don't think that's the best way to implement growth. If you want to criticize someone, they'll be much more open to it if you first gain their trust and give them feedback in a very secure, safe environment privately. So that is just one of many, many heuristics in the overall pantheon of emotional intelligence that I think is really important, that I try to live by every day, that I didn't necessarily practice every day 10 or 15 years ago. when I felt that it was do or die. You're in a startup, you have to be very honest and direct. I realized that sometimes if you're overly honest, overly direct, people close off. They don't share more information with you when you need information from them. They also might perceive you as being the bad cop. And I now really try to avoid that at all costs. I really try to be firm when I need to be firm, but really focus on building such strong relationships with people that if I were to at some point give feedback that's critical, whether it's to a CEO that I'm on the board of, their company, or in some other context, that they'll be open to it. And that idea of EQ mastery is not taught in law school. It's not taught in the workplace. It's something you just have to teach yourself and read books about and just really understand your interpersonal relationships, invest in them. You even see it in the online forums. You see people going after each other, very low EQ. When people don't approach discussions with empathy, with understanding, with respect, you don't have any growth. They're just two ships passing in the night. No one changes their mind about anything. So the addendum to that, Naresh, is I believe that it's important, if you want to make a difference, to focus on your influence, not being right. You could be wrong or right, but what you're really trying to be, whether it's within an organization or in life general, is influential, meaning you're trying to persuade people, trying to influence them to do the things that you believe in. And if you want to be influential, you have to follow a certain rubric. There's one way to be influential in authoritarian systems, which is you're the boss and you just tell people what to do. That's not really influence. That's more giving them directives and punishing them if things go wrong. Influence requires nuance. It requires understanding, again, trust, relationships, building a relationship, and having someone understand that your advice is really for their interest in a way that they would open up and listen to it. So,
yeah, those are two great points. Not paying too much attention to what people box you into, but then being open to ideas and curious. And the emotional quotient is something that nobody ever teaches you. I think the sooner a person realizes that, I think the more influential that they can be, the more successful. I think they're correlated, I think. Great points. And people need to realize that. Maybe that's a nice segue, and also connecting back to something you mentioned. You went from law school to the startup story. You are not a scientist. I wanted to touch upon this subject as a non-scientific co-founder at a biotech company. How did your co-founders perceive you? What were they boxing you into at that point at your first startup? Maybe you can walk us through that thought process of your own transition into the startup world as a non-scientific co-founder. And maybe there are some lessons we can dig out for others who are trying to either recruit a non-scientific co-founder or a non-scientist finding a scientific co-founder.
Great question. So the first thing I'll say is that maybe one way to answer this question is to emphasize a fundamental principle that I don't think gets exercised enough, which is you should not have stereotypes and prejudice against people. Don't judge people by the way they look, by where they come from, by their accent, by how thin or thick they are, by how short or tall they are, by what degrees they have. In general, it's a big mistake to make your judgment based on a single variable. These are all influential variables. For example, if you're judging someone on their ability to run a marathon, if their BMI is through the roof, then probably they're going to have a hard time. But again, don't judge. Try to look at it holistically. What I've noticed is that people, again, like to put others in a box. So a lot of the PhDs that I've come across just hated MBAs. As you know, I'm not an MBA, but they just hated quote unquote business people because they don't understand the science. And these are usually the PhDs that don't succeed. Those that are judgmental that way and that treat a whole segment of their business, like the people that don't have PhDs as being a problem, are not going to succeed because they don't have a growth mindset. It means fundamentally they don't understand how companies even work. They conflate success in a laboratory with success in a company, and they're very different things. To judge someone by not being as deep, pipetting and chemistry and things that you are, therefore they're not qualified to help you, that's very foolish. Some of the most successful people in our industry, both investors and executives, didn't have technical backgrounds. There are people that were autodidacts, where they learned what they needed to learn. But fundamentally, you don't need to understand covalent bonding to be the CEO of a pharma or biotech company. These are different things. What you do need to understand is how to avoid getting down around it, how to go and raise the right capital from the right partners, who to hire to design your clinical strategy, how to speak politely with the FDA to get what you want from the clinical trial design, how to then wisely negotiate a license or a partnership or an acquisition. These are things that you have no idea about if your skill set is confined to what you can do in a lab. And it's that hubris where people that are on the business side discount PhDs, or where PhDs discount the business people. That's when everyone loses. So one of the most important things is not being judgmental. So how was I perceived? I really don't know. You'd have to go ask them. But I did notice, I would hear in discussions, very dismissive comments sometimes from PhDs about, oh, that guy's a Harvard MBA. He must be a complete idiot. or this guy didn't finish his PhD, so this person doesn't know what they're doing, or this person's a VC, but they're a PhD, so they're a failed scientist. They couldn't make it as a professor, and now they're working at a venture fund. This type of judgmental, demeaning approach towards others is very destructive to value creation because it's not the way successful people think. Successful people think in terms of team building, in terms of bringing different competencies and variables into the equation to succeed. Successful people, if they're experienced at all, will have enough humility to know what they can do and what others will need to help them do. It's that famous proverb that says, if you want to run far, if you want to run fast, run alone. If you want to run far, run with others. And at the end of the day, any startup is an exercise in running far, not just fast. Maybe fast in the beginning, but at the end of the day, you have to go far. My own fund is an example. I started it by myself, and I was able to do a lot of things very quickly because it was just me. But if I were to try to continue operating as a sole executive in a venture fund, I would be horrible at it because I don't have a PhD, and you certainly require a PhD to go deep on a lot of the technologies we look at. No matter how smart I become reading articles every day, and I read a lot, I don't have the pretense of thinking that I can become super deep in everything that we look at, which ranges from not just nucleic acid molecular diagnostics, but device companies and spectroscopy and digital health and artificial intelligence. And we look at so many different things that even the smartest PhDs on our team aren't going to be conversant or expert in more than a few of those sectors. So again, you realize that being a Renaissance person, being a polymath, being good at relationships and drawing in others to help you diligence, that's the key variable in becoming successful. So I don't know if I answered your question.
I think in ways, I agree with your point about broad strokes of putting, again, it goes back to the boxing of people as, oh, all MBAs are bad. I think I was looking for more specific examples of what a scientific founder, for example, should look for in a non-scientific founder at the early stages, where take a PhD or a scientist, postdoc, has an idea. At that early stage, what should one be looking at? Because most of these people don't interact with anybody outside of the lab. That is the case. There's reality with most grad students and postdocs that I know of. So I'm trying to pave a path for them, give them some guidelines of what are the things that we should look for.
Very good question. The reality is that not everyone is going to be capable of running a company just because they're amazing at science.
To that point.
Not everyone should want to. So if they feel like they're the scientist that can grow into the position of a CEO, then they should aspire to become that. And there are funds like mine that specialize in helping them become successful in that very specific context where they're stepping outside of their core competency and need to pick up a lot of skills very quickly on management, recruiting, financing, fundraising, business development, et cetera. That's what we do. So we come to the table. To give you an example, our investment in Rewrite Technologies Therapeutics out of Berkeley and our subsequent investment in the spinout, Replace Therapeutics, both with the same founder, CEO, Shaked Halpern, was predicated on the idea that he really wanted to work with the best firm that he could find. And we were humbled to be that firm that could help him achieve outsized returns, outsized results, working really as a sole founder. He had David Schaefer, a professor at Berkeley, as a co-founder in the first company and a board member, but he was the only full-time person in the company as a founder running it and had to recruit a team around him. So what did we do? We helped him find and recruit marketing team, legal team, business development team, his COO. We even helped him interview scientists that he had brought to the table to help him close them. Not to mention, when it came to licensing and partnership and acquisition talks, I was very involved because those are the things that I knew quite a bit about. And so it was his growth mindset of understanding what he needed and working with the right party to help him supplement his own core competencies that I think helped him become so massively successful so quickly. $200 million exits back to back in genetic engineering. So I think a scientific founder would have to have that business savviness to be able to understand what they're missing and team up with someone that could help fill in some of the holes. If they find that they're just too far off the mark to even grow into that, they should find a co-founder that complements their skill set. Again, in my own fund, one of my first hires was a PhD because I don't want anyone to ever look at our fund and say, well, it doesn't matter how smart he is. He's not going to have the training that's required to understand how our single cell technology is going to work in the lab because he's never worked in the lab with single cell technology. And they would be correct. So precisely for that reason, I was realistic and knew that even if it's going to cost me money out of my own pocket, because of course, every time I hire someone, my own fees get reduced. So that was far less important to me than having the best team and understanding that this is a very difficult business, very competitive, and we want to be able to help founders and be able to diligence them properly. And so we require that internal expertise. You'll find some funds that don't have partners that are PhDs. And it's mind-boggling that they even invest in the space because you're a little bit throwing darts if that's the way you operate in our very, very complicated, heavily regulated, deep tech environment. So I think scientists would have to really think hard about how they can grow their teams with complementary skill sets.
That's great advice. Dave Schaefer was on the show. Phenomenal stories of his startups as well. You brought up your fund. Sorry, we didn't get your fund yet because there are so many good things that you're talking about. Let's go back to your Civilization Ventures. Maybe you can talk about the key principles that are guiding your current investment thesis at Civilization and how they evolved over time.
Absolutely, Naresh. So I started the firm in 2017, and I started it by myself with the idea that I was going to do things differently than I had seen other biotech VC funds do. Because remember, for a decade, I was a founder and executive in early stage companies where we were pitching ideas that were quite disruptive. I was pitching, in the case of NextBio, a software multi-omics company in 2006, which is before that stuff became sexy. I was pitching for Argenx, which is now called Inspirna, my therapeutics company based out of New York. We were pitching a microRNA-based discovery platform that had novel therapeutics, novel moieties going into man, going into human trials that had never really been in human trials before, at least not our specific designs and drugs. And it was considered very risky. The mechanism was risky or not validated as far as most VCs were concerned. Our targets in the clinic for our cancer drugs were considered risky because they were not the targets others were pursuing. And our small molecules, in the case of our 2 lead programs, were super risky because they had not cleared safety in human trials. So we basically got rejected by 99.9% of the people we talked to in both of those companies. And so I realized that there's just this enormous inertia, the lemmings mindset that VCs have, which led me to believe that there's a real opportunity for me to do something different. And it was a little bit, in the beginning, I was very intimidated by this because I'm coming without a PhD. And for the first 10 years of my career, I was just hiding behind the PhDs in our teams to do all the talking when it came to the science because it's deep. You don't want to say something stupid. And sometimes I would say something stupid because I was trying to talk their slides, and you shouldn't do that. It took me quite a long time to become super conversant and comfortable with the specifics of the science that I was pursuing. And I realized at that point that the counterparties, in this case, VCs who themselves had PhDs and MDs, didn't understand half of what we were talking about. That's when a light bulb went on. And I thought, oh, wait a minute. Even the smartest people in the VC landscape, their PhDs are way outdated. I mean, if you're a PhD from 5 years ago, you're already outdated. Because the science moves too quickly. And even if you were a PhD from 2024, doing one specific things having to do with new genomic targets for neurodegenerative diseases and a couple of therapeutics you were pursuing, what do you know about genetic engineering? Probably zip. What do you know about proteomics? Zip. What do you know about devices? Zip. What do you know about artificial intelligence? Zip. So really, the emperor is not wearing any clothes, and really none of the emperors are wearing any clothes when you think about it. People are walking around making investment decisions about deep tech ideas and products that they rarely understand. And so that was really an awakening for me. I realized that even a complete dunce when it comes to science, and I'm not calling myself that, but I'm saying even if someone were a total dunce and they started a fund, as long as they surrounded themselves with subject matter experts and had enough advisors, they could actually do as well as some of the more accomplished funds because that's what they were as well. They were big networks. If you look at some of the best funds in OrbiMed or a Column Group or an Atlas or a Flagship, they are a collection of people. They're a network. And there are people in those firms with vastly different skills. And the common thread has to be a leadership which understands enough about the industry to be able to direct everyone else to work towards a common goal. And after 10 years, I actually had that in spades because I was working in the industry myself on the front line. And we had multiple products in the clinic. I had multiple acquisitions. So I began to feel comfortable that, okay, I could start something here and have an impact. And specifically, I realized that the traditional biotech VCs, for whom I have tons of admiration, were very founder unfriendly, to be very blunt about it. At the end of the day, they work very differently than tech VCs. Tech VCs, when it's Benchmark and Sequoia competing against, Andreessen and Kleiner or what have you, they really are very competitive. They want to give a term sheet and take the entire round in the early stages. They don't really call each other and say, hey, do you want to join me in this round? That happens sometimes, but it's not really the way most tech deals are done. More often than not, you find that they are trying to close a founder or CEO before she can go shop it to others. Biotech is the reverse. Because so much capital is required to even get to a preliminary point of de-risking, you pretty much always syndicate, and you syndicate with the same people. So there's no sense of competition. Valuations tend to be a little bit more suppressed as a result of that. And it also lends itself to a lot of bad behavior. where someone on the board of a company can call their friend who's a VC in another fund and say, hey, I want to recap this thing. Why don't you give a term sheet? I can't do it. I'm on the board. And they orchestrate this down rounding of founders every single day of the week. And it's really sad because I think it's not in anyone's long-term interest. So I wanted to do that differently. I wanted to do things differently and not do that. I wanted to be founder friendly. I wanted to focus on mentoring founders and not recapping them or firing them at every opportunity. And I realized when I started this, I was really the only fund even talking that language that was being led by someone that had operational experience in a startup. There are more now, and there are some great funds that we work with that have a similar thesis. But in 2017, it was actually a novelty to be talking that way and a little bit crazy. That was the phenotype of the founder. And two, I wanted to focus on thesis areas that I thought were underappreciated by traditional biotech VCs that had this flywheel of Me Too drugs and small molecules or large molecules that they just were really expert in, and they didn't want to look at other things. For them to even look at a diagnostics deal is they're doing you a favor. To look at a devices deal is like, well, we don't really do that, but we'll look at it because you're my friend. You realize that they just weren't enthusiastic about it because they knew how to make money too quickly, too well in the categories that they were accustomed to. And so I realized, wait a minute, I've been investing as an angel in these categories. I've done really well as an angel. What is the logic of not investing more in genomics and diagnostics when in my mind, that's the future of healthcare is highly personalized, highly preventative diagnostics, often based on genomics information, whether it's a prenatal test like the one that BillionToOne does that is able to detect Mendelian diseases from an NIPT non-invasive test, which no one else was able to do before them, from a mother's blood draw. Usually you have to do carrier screening before you can get to that point. Or whether it's our company Foresight that's doing minimal residual disease detection in cancer with a hypersensitive assay that is almost at 100% accuracy in terms of telling you whether cancer is gone or not. That's the future. And so those categories, this genomics and diagnostics category is so essential to medicine. But if you look at most funds, they don't invest in it. That was my first focus area. By the way, this is in no order. I'm just going to give you all three. The second was this idea of synthetic biology, which is this term synthetic biology has become popular to describe essentially genetic engineering and manipulating cells. And it's an old concept. Obviously, we've been doing this since Genentech in the late 70s, 80s, but now it's taken on new currency with some of the accelerants like AI and obviously where we are with CRISPR in facilitating a lot of innovations. So I feel like synthetic biology, the idea of manipulating the cell in domains that include therapeutics, but also go beyond it, has really exploded as well. And within this rubric, we also include gene and cell therapies that we invest in. So SynBio is our second focal area. And the third is digital health. We've been an accidental early investor in digital health because I happen to be the first angel check in Omada Health, a company that's doing super well in the digital care realm. And I was an accidental first investor because the founders were friends of mine when they started it. But now that whole category and the whole idea of digital health has become this big thing. And so I made that my third category because I realized, again, PhDs sitting in these biotech firms that are familiar with lab work don't have a lot of comfort with running teams of software engineers or understanding what software is. I ran 2 software companies. I was very deep on the frameworks that were used, the languages that were used, the cloud computing processes and vendors that we used. And I was just early in that space. And so I felt very comfortable investing in software as it intersects with healthcare. So our 3 categories, again, are genomics and diagnostics, synthetic biology, which includes gene and cell therapies, and digital health and AI. And I found that that's actually very differentiated because you'll find firms that do 1 or 2 of these, but no firm that actually does all 3 and that does all 3 well. And again, we've been very fortunate that if you look at our fund now, we have category-defining companies in digital health. Included in that is Omada Health, but also Lemonaid Health that was sold to 23andMe. They had an incredible traction before the acquisition. We have category-defining companies in genomics and diagnostics. We had a company, Singular Bio, get acquired really early. We had BillionToOne, which is, I think, the most disruptive company in diagnostics to have come around in the last decade easily. And we have Foresight, which is also just crushing it in terms of their technology and their traction. And then when you look at synthetic biology, gene and cell therapies included, we've also been very fortunate to have 3 exits, which probably is more than any fund that I know of in genetic engineering as a discrete investment area. We have Rocket Pharma, which to this day is probably the best performing or one of the top 2 best performing gene editing companies that's gone public. Its stock price is actually higher than it was 3 years ago, not lower. Almost all the other peer plays are lower. Yeah. Rocket Pharma, very fortunate to have met Gaurav, the founder and CEO, is one of my friends in my last company. He was an advisor to us and was very fortunate to be a part of his journey. And he's just an incredible person, but he's persevered. I think our market cap is between 2 and 3 billion today. So that was one of our early successes. We have Replace and Rewrite that I mentioned as well that have exited in that space. So I feel like we built up a lot of momentum in each of our defining categories of investments. And that's not easy to do in the first 7 years of the fund's existence, but we feel like we've been very fortunate and we'd like to build upon that over the next decade.
Thank you for sharing about your investment thesis and all those stories. And what stands out when one looks at your profile or civilization is the number of exits in such a short period of time. If you were to go back to your role as a co-founder during exits in Inspirna and NextBio, can you share some stories of your role in shaping those exits? Exits is a very interesting topic because I'm sure investors think a lot about it, but not too many founders really think about it, especially in the deep tech space. The fate of most number of successful deep tech startups is either being acquired or merged with other companies. How can founders be better prepared for this space? But let's go into your journey in shaping those exits.
Well, I will say that Inspirna hasn't exited yet. I hope it does soon. It's been 14 years since I founded the company with a team of scientists out of Rockefeller University. But the good news is the company is doing quite well with respect to its clinical programs. And I hope that it even goes public as the markets open up again. Maybe the exits that are most recent in my memory are Rewrite and Replace, because I was on the board and they both sold in the last 2 years. This is a critical point that I think is easy to lose. One, I'm going to share a popular phrase that we used to say at Goldman Sachs that I think is instructive. And two, I'll talk about how you can orchestrate an exit. The phrase that we used to say at Goldman Sachs was tech companies, and I think it applies equally to biotech companies, are bought, not sold. This means that, sure, you can run a sell-side process and try to sell yourself, but not going to be very successful if there isn't already a huge appetite among the acquirers for that specific technology. You'll know if it's interesting to people because they'll reach out to you. Not that you have to sit in your lab and wait for them to call. You could reach out to them and try to do negotiations and licensing and make them aware of who you are and what you're doing. But once they are aware of who you are and what you're doing, they'll be the first ones to suggest an acquisition if it's the right thing. You'll see it very quickly. So you shouldn't be naive as to think that you just kind of sit in your office and hope people will call you. No, you have to have a process. You have to have a business development team that goes out there and tells people who you are. And I've seen companies do that very, very poorly, hiring junior people that have never closed a deal in their lives. And again, some PhDs just don't even understand how to evaluate these people, and they're not getting anywhere. Conversely, we introduced Rewrite to a good friend of mine that I had worked with a decade earlier, who worked at Roche and Novartis, very expert BD person, also a PhD and an MBA. And he was just an ace. I mean, he would all the top players and work on licensing and partnership deals. And one of those turned into the Intellia acquisition. Intellia bought us for $200 million, 18 months after we started, having only raised $2 million. It was really an outlier response, but it wasn't an accident. Yeah. So what I like to tell people is that it's very, very important to be lucky. And everything that's gone right, there's luck, period. Luck is an innate part of survival and humanity. Every time a baby is born, there's luck involved in that, right? Every time you cross the street and don't fall down, there's luck involved in that. But it doesn't mean that it's an accident. The reason it wasn't an accident is because we did everything within our power to set the path for success. And then we were lucky that for whatever reason, well, actually, I know the reason. We were lucky that our technology was such that Intellia really wanted to own it. And this happened just as we were contemplating a $30, $40 million term sheet by one of the top VCs in the category. So we had run a dual process. We actually hadn't even run a dual process. We were running a financing process while pursuing partnerships. And the partnership turned into an acquisition. That was accelerated by the fact that a financing was imminent. And the acquirer, Intellia, obviously preferred to buy the company versus seeing us get more expensive down the road if we were to hit more milestones. So it was critical that we had the pieces in place for that company early on. It was critical that Shaked is a real ace. He's a very exceptional executive that he always had, first of all, very coachable, was very open-minded to learning, which I give him credit for, not me. And once he met people, he was able to let them do what they do well to everyone's benefit. And so that was critical. That's a starting point. The next level was, how do you negotiate the exit? Once we had a term sheet for an acquisition, then we have to get into the weeds on all the terms. And that actually is where a lot of people fall short and where a lot of deals look terrible. We've had 9 exits. Of those, a few have not been profitable. I'm not going to mention which ones, but 1 or 2 of our exits were return of capital. In one case, not even full return of capital. These were very minor investments, but nonetheless, they weren't all Rewrite where we make more than 10 times our money or whatever it is. That's a rare outcome. And it's an outcome that has to be engineered with great skill. And you engineer it by working with the right investors. And this is a shameless plug where, again, many of our peers have never served on boards, have never been involved in an acquisition, don't even know how to read an acquisition agreement. Now, one could argue you just hire the right lawyers, But the person that would say you just hire the right lawyers is the person that's never done it. Because hiring the right lawyers is saying just hire the right developer to build your house. You have to understand something about construction and development to be able to oversee that process. So we brought on board, again, one of my friends who's one of the top lawyers that I've ever worked with, and he's an M&A guru. And his involvement was exceptionally important to the outcome for that company. But us having the understanding that we needed someone of his caliber, listening to him, and being tough in our negotiations that resulted in the outcome that it did. It's very easy in these negotiations to not understand which points are important. I don't want to go into details about a specific deal, but I'll just share generically that here's a term that people just don't even pay attention to if they're not knowledgeable. You're getting stock versus cash. Very different tax consequences. Let's say you decide to get stock. How do you get stock? If you're getting an acquirer's stock and that acquirer is a public company, if it's a milestone down the line, at what price are you getting the stock? Is it at today's price? $5 a share, let's say. Mm-hmm. And if their price goes up to $10 a share, well, now you've doubled your money by locking in the price of their shares today. But what if it goes down? Mm-hmm. Like many public companies have gone down over the last 4 years. Yeah. If you were locked into a $200 million milestone at a price per share, which has fallen by half, that just became a $100 million milestone. Mm-hmm. Of course, if it doubles, it's $400 million. And the acquirer, depending on their preferences, may try to persuade you one way or the other. But we, for example, when we're negotiating deals, view stock and cash as being the same. Mm-hmm. So if we're going to get stock, we want it to be like cash when it's traded. These are nuances that a lot of people overlook. There are so many moving parts in an acquisition, such time pressure, so much stress, that if you're not a complete ace on how to understand every deal point, these are business deal points, but they also implicate a lot of legal language, you're just not going to get the same deal. We've seen multiple deals that were multiple exits that were $400 million exits turn out to be $200 million exits because by the time we got paid the stock, the value had gone down and they pegged it at the wrong price. In contrast, where I've been on the board of companies that exited, we've never seen. Because again, if there's one thing I take pride in, is doing my best to make sure we don't get out negotiated. And it's a very difficult skill because negotiations involve stress. The deal can fall apart at any point. Again, there's so much experience involved in doing this right, but you have to always have optionality. You always have to have a plan B. You have to communicate that to the other side. You have to explain to them the reasoning behind your position so that they are able to internalize it and take it up the pole with their superiors and explain to their CEO why these are the right terms. There's a lot involved. None of this stuff is taught to you in your PhD program. The difference for a PhD or a founder financially in working with a B or a C player or working with an A player, like I hope we are, is the difference between making multi-generational wealth and making enough to pay for half of a down payment of a house. That's really the difference. And we've seen both outcomes. And I like to say that when they listen to us, we've seen the former outcome. So this is not to be trivialized. These are very important points. No amount of hubris or fancy degrees will make up for actual experience and actual credentials in getting this done. And again, there's a lot of lawyers, a lot of bankers, a lot of people out there with experience, but they don't tell you about their failures. They don't tell you about the outcomes that you can't. When you're reading a press release, you have no idea what the actual economics are because a lot of the devil's in the details. We had one company, I'll give you another example. This is called Aspect, where we were one of the first investors, and I was a relatively small check. It was in 2017. This is a company doing 3D bioprinting out of Canada. Tamer, the CEO, is just incredible. He's really, really strong and just a very humble guy. And he had a growth mindset. He's coming from Canada. So even though I was a small investor, he would reach out to me a lot. Sean, I want to do this. We have these players at the table for a partnership. How do I go about doing it? And I was humbled that he would come to me, but I gave him very specific advice on who to hire, who to work with. They signed a $2.6 billion deal with Novo on a cell therapy, billion, for a small company in Canada. You could achieve outsized results. You have to be smart. You have to be a hustler. You have to listen. In the case of both Tamer and Shaked, when I met both of these founders, I just instantly had rapport because they were humble, they were open, they were sharp, they were aggressive, and we saw that we could work together. And I love that experience. It's when you see people that are arrogant or they think they know it all, those are the companies and people that will not succeed, unfortunately.
Shahram, I know we're running short on time, but this has been so much fun. I wanted to cover so much more, especially on this exits topic. Probably I'll bring you back if you're up for it. And Tamer and Shaked, probably they can join the conversation. I think it'll be very, very educational. But thank you so much for your time. I really had fun. And I think my audience is going to love this conversation.
Thank you, Nadesh. The pleasure was entirely mine. If I could be of any help to you or to any of the founders listening, just let me know. My email is shahram@civilizationventures.com, or they can write to info@civilizationventures.com.
I will have that in the show notes. Thank you so much and good luck with all your ventures.
Thank you so much. Love spending time with you. Appreciate it.
Thank you for listening to this episode of the Lab to Startup podcast. You can find links to the resources and programs mentioned in these episodes, connect with Naresh, or subscribe to this show at labtostartup.com.